Okay, guys, welcome to the fourth lesson, entries and stop losses. So make sure you keep taking notes as you're going through all the material. You've obviously got access to these lessons, so you can go back and rewatch them. We're at the phase now in your trading where you've done the hard work, okay? You've analyzed your context, you've set your direction, you have identified that a one-day event has happened, that it's valid, that it's happened in a location that's okay for us to trade from, and you're now ready to just do the entry and the stop loss. At this stage, your thinking is done, okay? You now need to become a doer. It's about following a process, filling out your checklists, tick, 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 is it, isn't it, where do you put just entry, your stop loss? It's not kind of thinking and analyzing where to put your entry and your stop loss. It's, is it this type of trade, therefore my entry goes there. Okay, so you've done all the hard work, you've had discipline, you've shown up day by day. Now you need to just do. You need to just take the entry, place your stop loss, and then we're also going to, in the next shortly, go through exits as well. So now you're just the doer. Even if it doesn't feel great, you're still going to possibly have fear, doubt, will this one work? It doesn't matter. You've done the work. Now you just need to place the trade. Okay, so let's go through our different types of trades. There's only a couple, and then I'll talk you through three just slight variations that you also need to be aware of, because it slightly changes how you place your orders. Okay, so trade type 1 is just a straightforward order. You're going to place your entry as an order directly off the after you've identified that a one-day event has happened and that it's a valid event and you can trade from it. Okay, so step 1 is you've got your event. You know that you're trading long already because we're in the zone. Your direction is already set. You're not reanalyzing it. And we've gotten this entry here. It's a daily event with, as you know, red dot, green dot. Enough said. We're going to now place an order. You place your order box, so we're going to call it the S&D trade zone, from the close. So it's really the body of your break candle. This is the candle that broke the previous candle and provides you with a green dot. You're going to place the top at the close of that candle and the bottom at the open of that candle. So it means you're actually capturing just the body of the candle. Okay. And your box should also have a midline, or you can place a fib on to get 50%. This is just the midline, so it's 50% of this body. And then, simple, your entry goes at the 50% mark, and your stop loss, do it like a couple of 2-3 pips below the bottom. But essentially, the stop loss is at the bottom of the body. Okay. You're also at this point going to place your exit. I'm going to show you exactly how we work out our exits in the next lesson. There's 4 very specific phases we go through, and the exit is always clear. It's always the same, but we analyze the exit as much as we analyze these entries, and it's as consistent. The exit is as important. We don't let this trade start to run and then decide, have we had enough? Is it there? Is it not there? Do we want to trail it up? Should we grab some profit now? You don't want to think, okay? All the thinking's done. We're just doing now, okay? Entry, stop loss, and exit. You just don't know yet where your exit is because I haven't taught it to you, but it's as simple as the entry and the stop loss. It just is, okay? So you'll go on, you'll find where that exit is based on a couple of rules, and you just place it, okay? That's all we do. So step 6 is exit, place your exit, final checks. And step 7, really, really important, do nothing. You're going to place this trade and you're going to do absolutely nothing. This trade is either going to work out or it's not going to work out. What's really important is that, as you can see here, okay, on the day we placed our entry, it actually came down and wicked us in. Okay, the next day it wicked back there, grabbed some more liquidity, filled some more orders. Okay, the next day it went back and grabbed some more orders. And then we actually had a little bit of a gap here, and then it grabbed some more orders. We had 1, 2, 3, 4 days of this trade just wanting to grab some more orders. It's all in the same zone where our entry is. But when you try to over manage your trade, so you try to like this one, it came down, put us into our trade, and then we're in a slight little bit of profit. If you start to try and protect that profit by going to break even, these trades get broke. You get break even a lot, and then it runs. Okay, and when you have break even trades, it's fine. You don't have a loss. Yeah, you managed the loss. You prevented the loss, but you also incur some fees. There's fees for the swap fees and the actual trading fees that you've got to pay, the commissions. Okay, and this can actually like deteriorate your account slowly but surely, and it can also deteriorate your psychology. Okay, because when this happens, you get a break even and then it runs to your profit. It can be almost as damaging to your psyche, your belief, your short-term kind of mood about trading as a stop loss. And in fact, sometimes stop losses are easier to get over than loss of profit. It's, we're all different, but for many of us, losing out on profit can be worse than having stop losses. And we actually, the way we protect our stop losses is that we have new entries. If this wants to come below here and take us out, it's probably going to come and flush the liquidity completely. And we've got new entries in there. My back testing has proven that this kind of setup, going to the 50% so that we get as good a kind of ratio trade as possible, but also kind of maintaining our stop loss here and not going to break even, gives us the best profitability over time. So our strategy, we don't follow trades up, we don't go to break even, because the reason being that we're happy that we're trading longs because our 3-day tells us that this is a zone, a supply zone or a demand zone, because we're trading longs. Okay, it's demand zone. Our 1-day is also confirming a demand zone. We've got a demand zone inside a higher time frame demand zone. Our exit up here is, and we'll go into this when we go through the exits, but it's based on the same principles. It's based on structure and where liquidity is, and there's liquidity above here. The fact that this is providing demand zones where they're buying, they've already kind of tricked everyone to selling, and now they're buying. They want to go and grab liquidity up here before they possibly come back down and grab more liquidity down here. They might come down and flush this afterwards. That's why we've got this exit here, but we're expecting it to run, then we're out. Okay. So it's really important that you do nothing. Okay, it's called step 7 is do nothing, because you've done all the work, you've done all the hard work, you've done the analysis, you've stuck to your guns, trading longs, you've sat with this loss, it's flushed liquidity here, you've turned up again, you found a new trade, now you want to take those profits. Okay. And I think this was around about a 5-hour trade. Okay, so we sit through a couple of days of it just not really going anywhere. But then in a couple of days, we've got a nice 5-hour trade and we're out. Okay, automatically out. Let's now look at type 2 trade. Okay, and that's the liquidity flush. So we're actually going to look at the entry that we took when the liquidity was flushed here. Now, what you're going to notice here is that we're going to have an entry here on the liquidity, and then we get a second entry on this one day that sets up. So they're two different trades, because this liquidity trade is actually still trading off this setup where we had a stop loss. Okay, so we're still trading this. We had a stop loss, and now we've got an alert on the liquidity. So we're going to trade this, and then we get a new daily setup. We trade that again. So we actually stack two trades here, and they both run to our targets very nicely. Okay, so that first trade, okay, we've got our 1 day setup. Won't go through that again, but this one didn't work out. Okay, we got stopped out, and a day later, so we got stopped out, a day of nothing, and then a day later our alert went off because the liquidity here has been flushed. Okay, so we always said these supply or demand zones, price can either come in and get us into a trade like it did in the previous one and run. It can just run without us, or it can do what it's doing now, to come and grab the liquidity. And we're expecting this as a valid option. We don't have to go and investigate why our stop loss got hit. We know that price can do this. We just never know which one price is going to do. So we want to be able to be open to trading all of them. So our alert's gone off. The first thing you do after your alert's gone off is you move to the 4-hour chart. Okay, and this is what that alert looks like. Okay, we're a couple of 4 hours afterwards, but you would have seen just this one wick out. Cool. So now you're just going to check your 4-hour chart until you get your first S&D on the 4-hour, and it's a bullish S&D, which is red dot, green dot, and it closes back inside your liquidity zone. Okay, that's your rule. So from here, there's 1, 2, 3, 4, 5, 6, 7, 8. 4 hours. It's basically a whole day, more than a day. Okay, so you know that on this 4-hour, an S&D is only going to happen if it breaks above here. So you can set some alerts for yourself so that you're not trading, you're not having to check this all the time. The alert can tell you if you want, or you can just set your alarm and go and check the chart every 4 hours. Obviously, there's some sleep time, but as you'll see, these things don't happen instantly. We have the candle set up, then we still need price to kind of do some things. Nothing it very rarely happens immediately. Obviously, as soon as you get this alert that price is back inside and it's closed and you see it, just set your order. Just go in and place your trade. Don't sit around. But you often, you can have a bit of time for these things to set up. So we're not trading here on the 1 minute. We're on the 4-hour. The reason we're on the 4-hour and on the 1 day is because it gives us the space to just be thoughtful about what we're doing, to get our checklists out, to not be rushed. Because remember, we've got that underlying stress, that underlying, our fight or flight is fighting with us, because we're thinking about putting money on the line. And this kind of pace of trading allows you to just be very structured, thoughtful, not do stupid, irrational things. But also, as you're learning, if you're not full-time trading yet and you don't have the time, this is really quite easy to do while you've got a day job. If you set aside, times of the day that you come in and check your chart or alerts, and you can kind of find some time and go to your trading charts. Okay, so we've got this closed back inside. Perfect. We're now happy to trade long again. Okay, we're happy that this flush has happened. We know why this flush has happened. We're not here doubting, are we going to go short? No, we're not. We know that this flush has happened, and this bullish close, S&D on the 4-hour back inside, gives us the signal of This flush is complete. Let's get back into our long trades. Okay. So we're going to, again, just set up your S&D zone on the body of this candle. And the slight nuance here for the liquidity flush trades is our entry is going to be immediate. Okay, we're not going to go back to the 50% mark. We're just going to trade the full. So it's almost a market entry, and your stop loss goes at the body. Why do we do a market entry? The reason is sometimes price will come down and grab the full, around the 50%. Sometimes it will come and stop us out. Okay, these aren't guaranteed trades. They just work more often than not. But the reason we want to place a market or an entry immediately is that because it's flush liquidity here, these often will move, it's taken out everyone's stop losses. These will often just run pretty fast. And we don't like trades to just run away from us. So we want to dig in on these. We'll have a look at what this trade came to in a second. But we want to be in on these. We want to be a little bit more aggressive in our entries because it's already flushed that liquidity. And we, it might come and flush some more liquidity, sure. These can get stopped out, but we want to be in on these. We don't want to be missing these trades because, again, we've just had a stop loss. We don't want these running away from us because guess what? It's painful losing profit. Okay. And here's our exit. Our exit is the same as our 1 day exit. It's going to be the exact same strategy, and we're going to go through that in the next video. We're going to have a whole series on where to set your exits, because after you've set your entry and your stop loss, you're going to go into your exits analysis and just have a quick look at where is the next exit. They're really easy to find. They're really straightforward. It just is. It's consistently the same. Okay. Now, when we set this exit, this actually gives us close to a 7 RR trade. So it's a pretty nice trade. We don't want these running away from us, which is why as you start trading the strategy, you don't mind the stop loss so much on the 1 day, because usually these 4-hour trades give you better risk reward, and therefore you get more profits when they work. Okay. And then here it runs. So you can see this one didn't even come down to the 50%. It sat here, and as I was saying, it gave you this 4-hour, this 4-hour, this 4-hour, this 4-hour, and I think this 4-hour also had a little pip onto it. So there was time to get into this trade, but again, don't wait for these, because just as much this could run on the first candle and never come and pip you back in. So you want to get in on these trades as soon as they set up. And again, do nothing. We're not trailing these. We're not going to break even. We're just trading. We're just in and we're trading them. Okay. So this would have been double stacked up, because what's actually forming here is that 1 day. We're on the 4-hour chart now, but on the 1 day, we had an S&D here. We set up our 50% entry, which was round about here, and that trade ran as well. So together, in the space of about, I think, 4 or 5 days of this to run, we had a 7 RR, and the other one was a 5 RR. So it gave us a 12 RR profit overall. And of course, we had the one loss previously. Okay. Now let's look at a few variations. These are really important. So far, our entries have been really simple. Let me just go back and remind you. The 1 day, you place your S&D zone, and the entry is at 50%. So the S&D zone is always on the body, 50% stop loss at the bottom. And for the liquidity trade, also S&D on the body, but you're doing a market entry and the stop loss below. Okay, now the variations. Okay, so if your S&D is a small body, so this is a regular one, the one we just looked at. It's a decent sized body. Okay, this is another S&D. So here's our red dot, green dot. But notice that this green dot, the body is less than 50%. So it's a bit too, it's just inviting a lot of, area here where we think price is very likely to break below the body here. Okay, so the back testing also proves that these mostly get stopped out because price wants to generally come a bit further in here. Doesn't mean that price can't come all the way, still stop you out no matter what you do, but it's just that 50%, less than 50% of the entire candle, if the body is less than 50%, you need to make an adjustment. And the adjustment is that we include the full wick. And we still trade at 50%. Okay. So you want to have that one variation for a small body breakout candle, a green dot candle. Okay. And here's the actual trade. So we placed it at 50%. It came down, came quite deep actually, but this one worked out well, and we got a good entry and no stop loss on this one. There were so this was in the euro dollar. There were similar setups on a couple of other pairs at the same time, and on one of them this wick was liquidated. It was wicked out. So this again, it's not foolproof. It's just that the back testing shows that more often than not, these can be relied on. And again, we're trying to not avoid all losses. We're trying to get the most profit while avoiding the most losses. It doesn't mean we want to avoid all losses. Okay. The second variation is where your S&D actually is a gap. Okay. So this S&D actually happened on a 4-hour chart, but you can see that and this red line is the liquidation line. So we want to trade an S&D on the 4-hour that closes back inside, right? But this candle closed down here, and this candle closed up here. It's a gap. So there's a gap in price here. It jumped from there to there. So we want to now set our S&D on the gap where the remaining gap is, and that's where our entry will be. And you want to therefore set your stop loss on the close of the candle that formed the red dot. Okay, so that's the variation for the gaps. If your S&D encompasses a gap, you want to find the gap that's not been closed, and that's where your entry will be. Okay, they don't happen often, but it's good to know what to do when you do have a gap zone, because you don't want to be left going, I don't even know how to trade this, and then you start either missing out on your trade or you start making up things to do. Okay, so we placed this one here on the gap. You can see it came back to fill that gap. Most gaps want to be filled. It doesn't mean that this trade can't run without us. Okay, but generally, if we just did our regular entry on this candle, most of the time with gaps, you're going to get stopped out, and it's not fun. So this way we got a great RR, and actually this trade within 2 days ran to close to 10 RR. Like I was saying, on these liquidity trades, liquidity flush trades in the 4-hour, we can actually sometimes get really, really good RRs, and we leave these to run to target. Okay. Then the third and final variation is a multi-candle S&D zone. Okay, this is where we've got a red dot, and then we've got two candles that are kind of trending upwards. The second candle is the green dot, but you can see that there's a very little pullback between these two candles. It's almost like the price has just soared. So you've got to kind of look at this as one candle, and therefore we put our S&D zone across both bodies and we just trade again from the middle, the 50% zone. Okay, so just think of this as one candle, because this move down here is very minor. Okay, if this had a fairly big wick to the top and then a big wick down here and it ran again, you can see these as two separate movements, and therefore we only want to focus on the movement that does the break. But this is kind of like one consistent movement. It just happens to have played out over 2 days. So think of this as actually being one candle, because it's just slowly moved up, and therefore you want the whole of that move and then 50%. And I think, yeah, this one also traded nicely. These also, again, it's not foolproof. These have losses as well, but generally placing your stop loss and your trade just on this breakout candle, you more often than not get stopped out when these candles set up like this. And so we want to kind of try and capture the most profitable trades we can. And okay, and again, the exit was the same as we've previously been trading. I'm going to go through exits on the next lessons. Okay, have a final look at principles here. So when you are going to start trading these entries, they really are simple, but you need to complete backtesting, 100 backtests. The main reason is that you need to practice seeing these setups and practice yourself being on the charts and seeing them and knowing where to put your entry, your stop loss, and your exit. You want minimum of 30 on a single asset before you trade that asset. So if you're going to trade euro dollar, go and do at least 30 backtests on the euro dollar. Because what you'll notice is some asset classes might have little specific patterns. So that's number 3 here. Beware of asset specific patterns. You sometimes find that a specific forex pair, or perhaps gold, or perhaps silver, or I don't know what you're trading, oil, you might find that more often than not, your main orders are getting flushed out by liquidity flushes, and therefore you might on that one asset decide, I don't want to trade the main orders, I just want to trade liquidity flushes because there's enough of them. Okay, my back testing, when we trade this way, and I've got more advanced entries, and there's a lot of ways that you can start to advance this strategy, but this is the basic entries. Okay, and it's important to trade these first, get comfortable. These entries, just the main orders and the liquidity flushes, give you so much profit that you don't need to trade other variations, etc. I'm a full-time trader, so this is what I do. I trade the main strategy, and then I spend my time testing more advanced versions, how to trade on lower time frames, how to get more specific entries so that I can have lower risk, more aggressive stop losses, and then higher risk rewards. But when you do that, when you start going down to more advanced strategies, you'll have more profit, but you're going to have a lot more losses. So it's important to just trade something, become comfortable with how many losses there are and how much profit you get according to those losses, because you need to be comfortable with something. Be successful with something first. Be successful with this strategy, even though you might think it's quite basic. It's great. This will pass your funded challenge accounts. This will give you profits, a lot of profit. But trade this and be successful with this before you start getting into more advanced strategies. And you need time everything has to be tested. Everything has to be checked. You've got to complete. If you make any changes, you need to redo your back testing. And 100 is the minimum. You need a lot more. And 30 on an asset is the minimum. You need a lot more. And you need to redo that every time you do anything more advanced, make changes. So I can do that because I'm a full-time trader. I've got time on my hands. This is my job. This is what I do. But when I don't have time, when I want to perhaps spend a bit of time doing more exercise, doing things outside of trading, working on other businesses, I just trade this strategy because this is enough. It's a really great strategy. Just start working through it, becoming comfortable with it, and it's going to give you everything you need to just get to that point where you can get past the jumping around from strategy to strategy, and you become an expert at one strategy and become an expert at this level, these 1-day orders and these 4-hour liquidity flushes. And then from there, you can start building and building and become the consistent, profitable trader that you want to be. So the next lesson is lesson 5. We're getting through this course, and we're going to look at exits and targets. So targets and exits. It's really simple, but it's really important that you follow these, that you don't start. I just want to go back to a very important slide. You don't want to start this one. Do nothing. Don't forget step 9 is do nothing. Once we set our target, step away. Just check in every day to see if you don't have a liquidity flush or what your daily is doing. But don't tamper with these trades. Okay, you're the biggest risk. Remember, just do nothing. Step away. These exits and these targets, they work. Okay, so I'll see you on the next video. Go through exits and targets. Okay, well done. I'm really proud that you've gotten this far. Don't stop now. Keep going. It's really going to pay off, and I look forward to seeing you in the next video.